Okay, you're at that point where you're like, you know what? I'm seeing all these people online. Like, I'm going to move into syndications. I'm going to start buying bigger units, bigger properties, and putting my name on it. First thing I'm going to ask you is, are you doing that for the right reasons? Are you doing that for financial freedom, for growth, or are you doing that for your own ego? I only ask that question because I found myself for a long time, I'm going to get 1,000 units, 2,000 units, and I was getting more and more and more units, but I wasn't making any more money. So ask yourself that question first. Number two, let's get into what that actually looks like. When you're syndicating, you are locating opportunistic or value-add real estate or core real estate, either cash flowing, stuff that has some hair on it that needs some work, or a full opportunistic development project. And you are going to be running all the numbers, doing all the due diligence on the property, and you're going to be syndicating capital. You're going to be reaching out to your friends, families, and acquaintances, those that might have capital to place in your deal. You have to be super careful how you do this because there's different ways of registering with the SEC. And yes, you do have to register with the SEC, including if it's an exempt project. There are two different types. There's 506B and 506C. We'll get into that in another talk. Just be aware that one of them, you cannot advertise that you are raising capital for your project, which makes it a little more difficult. You can only go to the people you already know, already have a relationship with. That's a good place to start anyway. The people that you're meeting with now at this point, they're going to want to know, like, do you have a track record or is this your first one? You're going to have to know and educate them on why the area, why the deal, and why you for the project sponsor. And that they have the right to ask all those questions. You're going to have to go through the worst case scenarios. You're going to have to go through a stress test of your deal. So it might make sense on paper right now, but what if taxes increase by 25%? Insurance goes up by 15%. As we're seeing now with inflation at 14.9%, what if expense ratios go off the charts? How does the deal look then? If the deal still works after your stress test scenarios, chances are you do have a pretty good deal. And you should reach out to the people you already know and trust and ask them, hey, can you poke holes in this? Can you tell me what's wrong with this or what I don't see? Maybe you're going to partner with a more experienced operator. That's how I started. Partner with a more experienced operator in that space so that they know what you don't know, and you can really eliminate a lot of risk by just doing that. They can also probably help you raise capital. Now we'll talk about how that capital raise actually works. So we already talked about that. You can't openly advertise if you're one of two different registrations on the SEC. So what we're going to talk about is how the capital stack looks. So you're going to buy it for, let's say, $1 million. You're going to put in $1 million into it. And based on your numbers, you're in for that $2 million, plus your holding costs, plus all your investor returns if you have any, plus all this. You're into it for, let's say, 2.8. But your numbers say it's going to be worth 3.5 on the way out, or 3.5 in an appraisal in 3 years after you do all your value adds to the property. If that's the case, you're going to want to figure out what kind of debt do you want to put on this. Is it bridge debt, which is really short-term debt, like 12 to 24 months, interest only? They'll typically have less down, and they can probably front a lot of the construction funds, but it's a 1.5 to 2 year debt, meaning that you're going to be at the risk of the capital markets in 2 years when you have to go refinance. They're short-term money. They don't want to do long-term. So you don't know what the rates are going to be in 2 years. You don't know if the banks are going to cut down their LTVs to 50%, which we saw in the last 1.5 years. It's a significant risk to do that, but it's a way to get into deals for cheaper. So a lot of investors are still doing that. In our next video, we're going to talk about a massive foreclosure that actually happened in Texas because of that. So you want to be really careful how you structure your debt. The other debt you can place is stabilized debt, or maybe a 5-year fixed term debt. It's a 10-year term. So you don't have to worry about that refinance risk, but typically they're not going to give you as much for construction. There might not be an interest-only period to help you get stabilized up. You might have to come up with a lot of money up front to fund reserves, to fund your construction, and make sure you know what you're going to have to raise from your LPs. We'll talk about that in our third segment here. So we talked about debt, and we're putting together what's called the capital stack for a syndication. So you are a GP or general partner. You're the one that's helping control and make decisions and affect the business plan on this deal. Maybe you have partners as GPs as well. Maybe it's one LLC with a few different partners in there. Whatever it is, though, you are the ones in charge, and you're also the stewards of any money that you end up raising. You're also, anyone who's a 20% owner or not, is going to have to sign most likely on the loan. So you have a lot of responsibilities. In our last video, you've decided whether or not you wanted to go with bridge debt or stabilized debt to start. That's usually between 60 to 75% of your acquisition, and depending on what kind of debt, you either have 0 to 100% of your construction funds that come in from the debt. And that rate will be anywhere, we're here in 2023, so those rates are going to be anywhere from 7% to 11%, depending on what kind of debt you choose, whether you have a good broker or not. Now you're setting your equity. Equity means cash in the deal. Where does it come from? Typically, as GPs, can you set up a deal where you don't have any money in? You can. However, your investors are all going to ask you, how much money do you have in the deal? The answer is you probably want to have some money in there. The investors are going to want to see you also have something to lose. So GPs typically minimum have about 10% of their own equity in the deal. At that point, now you're structuring how to bring in the rest of that cash, the cash to cover the down payment, any sort of rehab that's not covered, closing costs, cash to operate for the first 6 to 12 months because you're probably not going to have a lot of cash flow while you're going the construction and doing the value adds. Reserves. You're going to want to fund all of that using your funds, GP funds, as well as what we call LP funds or limited partners. Limited partners are agreeing to put in money with you as a general partner, and they get a specific return on that money. They also get equity in that deal. So let's assume for a second that you've carved up a deal where the GPs, you guys, get 50% of the equity on that deal. You're now raising capital. Let's say you're raising about $600,000. You're raising $1 million. Anyone who comes in with capital above your 10% is coming in. That whole pool is going to be assigned 50% of the ownership. And you might do something called a preferred return or a pref to incentivize the LPs to bring it in. A pref is, let's say they come in for $100,000 or someone comes in for $100,000. The first 8% preferred return, the first 8% that property generates, be it on year 1 or year 3, the first 8% from the moment of closing is going to be starting to calculate and is going to be owed to the investors. It's just a way to incentivize them, and it shows them that, hey, 8% goes to you first before we get anything. It shows you that we're working for you. Pref returns can be anywhere from 6 to 9% depending on the asset class, depending on if it's core stabilized, depending on a whole bunch of different factors. We're just using random numbers. At that point, there's going to be a business plan. How long are you going to hold the asset for? Your investors really want to know that. Are you prepping them to make sure they're in it for the long haul? In 2023, you don't want to have any sort of short-term really short-term It's important that you and your LP investors' goals do align with if they're placing money with you, and let's say they might need that in 3 years to help fund their kids' education, that's not good for a 5 or 10-year hold. So you want to have all those expectations, meet with your investor, and just share. See if goals are aligned. See if the asset class or risk profile for them is aligned. Your job is more of an educator, but it's also a big problem solver because it's going to be up to you to generate those returns that you're promising and to affect all the value adds in your business plan to make sure that these investors not only appreciate you doing a good job, are getting their returns, but they'll also reinvest with you as they start getting their money back. Another big thing you're going to get asked is, hey, are you planning on refinancing the property in 3 years or 2 years or 5 years? And do we get any principal back from that? We've structured this in the past. For the last 8 years, it's been easy to find these things called BRRRR deals. Everyone knows this term from BiggerPockets. Buy, rehab, rent, refinance, repeat. You could do that and get all the cash back all day long. It was awesome. And then something happened in 2022. The rates doubled in their pricing. Capital markets, banks got scared. People got scared, started running on these banks. And banks got more scared, so they started reducing LTVs, upping their commercial rates even more, reducing their risk profiles. Cash out refinances can still be done, but not at 75% of after repaired value like everyone's been taught. So you want to make sure if you are planning on a refinance to what we call recapitalize the asset, bring the cash back into the project, that then some of it gets pushed back out to the investors to return their principal. You want to make sure that you're not counting on that in your returns, because of what could happen. You don't know where the banks are going to be. This was a major problem for a lot of syndicators that started in the business from 2013 to now. They didn't understand what was going to happen if capital markets started to freeze up or they got scared or the market started to decline like it is right now. So they bought the property, maybe wrong, or they overpaid for it. They then over-rehabbed the property, and then they went to go refinance the property, and all of a sudden the banks were like, it's not worth what it's supposed to be worth right now. We can't keep, the appraisal's not coming in. Or our LTV is no longer 75% of your post-stabilized value. It's now at 50. Or our rates are no longer at 4 and 5%, now they're at 8. And you need to be at a debt service coverage ratio of 1.2, so you can't qualify for this loan. If you can't refi in years 2, 3, 4, or 5, and you promised your investors that you would to recap that money, number one, your investors are going to be upset because maybe they had that plan for something else. Number two, your returns are not going to be what they were anymore because now it's going to be a long-term investment. So the point here is make sure you set those expectations and you don't promise anything that you don't absolutely know can happen. We tell our investors right now, like, hey, it was a great ride from 2013 until 2021, but the banks are now in a different place. So while we're buying this with the intent and we have the ability to do a cash out refinance in years 2 or 3 and maybe get a lot of our money back, we don't know how much, we don't know where the rates are going to be. So for right now, Mr. Investors, let's keep this as a long-term hold for you. Assume it's a long-term hold, and you're still going to be getting all the cash flow benefits, all the ownership and tax depreciation benefits along the way, as well as retaining your entire piece of ownership so that when we refinance or when we sell, you get your preferred returns and you get your IRR of, let's say, 16 or 18 or 20 or 25%.